Good day, friends. In the lecture series on personal financial planning, in my previous lecture, I was talking about steps in the financial planning. In this lecture, to start with, I'll continue with that of the steps of financial planning. In my previous lecture, friends, I've talked about 3 different steps for the financial planning. That is, determining your current financial situation, in which we jot down, we write down, or we assess all our assets, all our liabilities, and determine our net worth, so that we know exactly where we stand, what is our financial status, right? And we also make a statement, or when I use the word statement, we tries to find out that what are your current level of income and what are your expenses, right? So that we can know where the financial whatever the financial situation is your income is enough to meet out your monthly expenditure and the expenditure that arise all of a sudden in contingency expenditure. What is your level of saving, how much income you are able, what proportion of income you are able to save. So basically we want to know the financial situation of the individual who is making the financial planning. It may be for the individuals, it may be for the whole family, right? So, and then you determine your developed financial goals, what you want to achieve, what are your financial goals, when you want to achieve it, right? So the financial goals may be different apart from meeting current expenses, your current monthly expenditure on food, education, health, right? Monthly routine expenditure, what your goals are. So you have to plan for that. You want to buy a house, you want to buy some good assets, you want to go for a foreign trip, right? For the occasions, you want to arrange some social function for any occasion for which there is a heavy expenditure involved. It may be marriage, it may be birth of a child, or like that. So these are your financial goals, the different type of financial goals, depending on individual to individual, depending on your priorities. So when they will arise, how much expenditure in terms of the current price level, and keeping in mind the average level of inflation, what will be the expenditure at that time, right? So keeping all this inflation in mind, keeping your current financial situation, how much you want to spend on it, you determine your financial goals. And then that identifying alternate course of action. When I say identify, that whatever you are saving, that saving can be invested in various investments, which I discussed in my previous lecture in length, that it may be in equity shares, it may be in bonds, it may be mutual funds, real estate, gold, painting, right, and so on and so forth. So you jot down, what are the different alternative course of action. Friends, still I tell you, in India, the financial literacy is very, very limited. I'll be talking in the end about the financial literacy, but I'll tell you that financial literacy in India is very, very limited. If you ask a common man in Indian cities, or say villages especially, what the options they have, they will say that whatever they save, they deposit in the bank. So bank fixed deposit is the only thing which they know, or they deposit their money in the post office. They are not even aware that there are certain investments opportunities, there are certain investments which can give you higher return, which are as safe as the bank FD or as the post office deposit may be, which can give you higher return, because they are not aware. They are not aware about the different schemes of the government of India, which if you invest in those schemes, which can give you higher returns, right? So keeping in mind the tax consideration and other consideration, there are various aspects of it. I will be talking in length later on. So what are your different alternate course of action? This you have to find out. Once you know the different options, then the next step is you evaluate alternatives. I said first we find out that these are the different alternatives which are available. What are the pros and cons of each of these investments? Keeping in mind the risk again, keeping in mind your age, keeping in mind your income level, keeping in mind the tax consideration. Just to take an example of tax consideration which is coming in my mind, that say public provident fund, PPF, right? See, why do people prefer PPF as compared to FD if they want to make a long-term investments? Because the PPF is for 15 years, right? So if you want to make a long-term investment, the return on PPF is better than return on bank FD. Say bank FD will give you 6% return or 7% return, say. PPF will also give you 7% return. But the interest income which you earn on PPF is tax free, is not taxable, right? Suppose you deposit 1.5 lakh rupees every year in your PPF account, it is tax exempted, the interest that is earned. Plus, it qualifies under section 80C. 80C means if you invest, if you are in the old tax regime, then in that case, that if an investor invests up to 1.5 lakh rupees in the PPF, right? So under 80C of the Income Tax Act, that is qualifying for the deduction for calculating of taxable income. So tax benefit is a big benefit of the public provident fund as compared to bank FD, right? So each of the alternate has its own risk profile. People normally say the return in the stock market is higher as compared to any other asset class. But no doubt that return in the equity class is equity investment is higher as compared to other asset classes over a period of time if you take a span of 10-15 years. But the risk of in equity is also high because stock market keeps on fluctuating, right? Sometimes it is on the booming market, sometimes it is a depressed market. In a booming market, stock prices goes up, and in the depressed markets, the stock prices comes down. And suddenly you need money, right? Although the investment in the equity market is very liquid, right? Anytime you can sell in the market, and these days on third day, the money will be created in an account. The good thing about equity is that it is quite liquid these days, right? It is as liquid as you can say the bank account. But I would say that it is less liquid in the sense because there is a higher degree of fluctuations. In the bank deposits, there is no fluctuation. Whatever you know exactly the amount which you will be getting whenever you will withdraw, right? But if you invest in the equity, the price of equity keeps on fluctuating. So that is a risky asset. It can give you no doubt higher return, but that is risky. So those investors who are ready to take risk, higher degree of risk, those who can afford to have a higher degree of risk, because the value of your investment even may come down. You have invested 10 lakh rupees in the equity. A point will come, a time may come where this investment will be 7 lakh, 8 lakh, anything less than 10 lakh rupees. It can be. 10 can become 20, but 10 can also become 2, can also become 5. So means what I am trying to say that the investment in the equity is, the value of the investment keeps on fluctuating. The simple point I am deriving is that different alternates have their own risk, have their own return, have their own tax benefits. On the basis of all these consideration, keeping in mind your priorities, right, you evaluate your investment. Say for example, if I want to invest in the equity, even in the equity, there is a investment for long term, there is an investment for short term. The rate of tax in the short term investments is higher as compared to the rate of capital gain in the long term. If you buy an equity share and hold it for more than a year, then the rate of tax will be different than as compared to if you buy the share and sell it within a year, your rate of tax, you are under long term capital gain, right? So your tax will be different. Depending on the time horizon of your investment, you take a call on it, right? Depending on the risk. Suppose there is a retiree person, he is in the age group of 65, 70, he has only limited capital, out of his long working age group, right, age life, right? So he has saved, say for example, 50 lakh rupees. Now with this 50 lakh rupees, he want to spend his rest of his life, or she want to spend rest of her life. So her risk bearing capacity is very, very limited. Suppose this investment comes down, then it will be difficult for her to meet out her monthly expenditure, right? So a person who is in the senior age group, who is senior citizen, the risk bearing capacity is less as compared to a young person who is in the working age group, right? Provided I am presuming that that person doesn't have other source of income, that 50 lakh rupees which that person has, only that much money the person has, and there is no other income, there is no other source of money from which the person can meet out her monthly expenditure. So the risk, so on the basis of risk, the investment decision will be evaluated. Similarly, not only the risk but tax. Supposing I am in the 30% tax bracket, which is the highest tax, personal tax bracket in India, right? So sometime you make certain investment in order to save the tax, right? Supposing there are different schemes in the equity also, which are on which up to, if you invest up to 1.5 lakh rupees, it qualifies under section 80C of the income tax, which is that much amount of investment is deducted from your total income for calculating tax liability, right? So for investing in that scheme, the tax consideration is the sole criteria, right? So what I'm saying is that different alternatives have different returns, different risk, different benefits. Keep evaluating these pros and cons, and depending on the individual, you take a call on it, right? That's why we say every step of the financial planning is tailor-made. It's not a ready-made plan. It is a tailor-made depending on your own requirements, right? So you evaluate alternatives. Then create and implement your financial action plan. Friends, you have identified different courses of action. You have evaluated your alternatives, that you have find out the pros and cons of each of your investment. When I'm using the word investment, means whatever you are saying, saving, those savings is to be invested in order to achieve your financial goal. Ultimate goal is to achieve your financial goals, had a good life, good standard of living with your limited income, right? So then, on the basis of these evaluation, you create and implement your financial action plan. Create and implement your financial plan is a broader term which includes your expenses, which includes your managing your savings. When I say managing your savings, it means that you have to be disciplined so that you can save enough and you can reduce, or I would say you manage your expenses in a manner so that you have enough savings. And what is enough? It is a subjective term. Depending on your income level, right? Your enough is being decided. So you plan your savings, and then whatever from this saving you want to invest, wherever you invest on the basis of the above 2 points which I just talked about alternative course of action and evaluating the alternative, right? You implement your financial action plan. And finally, review and revise the financial plans. When I say review and revise the financial plans, see, no investment, no financial goal is a static term. It keeps on changing. Supposing something happens in the family, a new member joins the family, right? So obviously you have to review your expenses, you have to review your savings, you have to review your investment. So it's a dynamic concept. Friends, financial planning, you have to review your investments, you have to review your savings, you have to review your savings as the situation arises, as the fresh. So that's why I say it's a dynamic situation, and it keeps on revising as per the requirement. Suppose you invest in gold. Gold in India is a very traditional investment, and especially in Indian women's, gold is a very beloved investment, right? And they are wise enough. Gold has, over a period of time in India, has given good returns, if you talk in terms of return. But I would say that these days, there was a time in India some 10 years back, the Indian household used to, whenever they had to invest in the gold, they used to invest through jewelry. But nowadays, the digital gold, investment through digital gold is very easily available, right? The government of India has come out with gold bonds, whereby in which 2.5% annual interest will be given to you, and after 8 years, whatever the escalation, whatever the increase in the gold prices will be, your investment will be paid back to you, and there will be no tax on your income which you will generate on that investment. So instead of buying the gold in the physical form, people should buy gold. It's just an example I am giving. So I mean, earlier, since this option was not available, so the people who wanted to invest, they used to invest through physical gold only. But nowadays, there are, I mean, the stock exchanges also invest in gold through digital gold. Government of India comes out with the gold bond schemes. So it is better if you want to invest. Buying a jewelry is something different. By investment purpose, if you want to do, then instead of buying gold in the physical form, it is better to buy gold in the digital form. So what it means simply is that keeping in mind the situation and the new opportunities which are available, your financial plans keeps on changing. Earlier, some 10 years back, 15 years back in India, there were very limited mutual fund schemes in India. But nowadays, there are a whole host of, I said that almost there are 2,000 different schemes which are running today for different management mutual fund houses, right? So you can invest any of these schemes depending on your requirement, right? So we keep on revising these financial plans as per the situation. So all these I have written in detailed form, right? Means I have jotted down in written form. So determining your current financial situation, having a thorough understanding of your current financial situation will help you to formulate and realize the well-informed goals, right? To gain insight into your current situation, it can be helpful to determine your current net worth. I talked in the first point. To calculate your net worth, you will need to total your liabilities and subtract them from your total assets. Means whatever your assets and your liabilities, assets minus liabilities is your current net worth. I am quickly revising it because I have already talked about it, right? So assets are simply what you own that has a value. This include cash equivalent, physical cash in hand, bank account, saving account, personal property, equity, bond, gold, real estate, and car, etc. Liabilities include value of what you owe, including current bills and outstanding debt. Then the next step, it is just a repetition of what I said earlier, right? So quickly, I am revising it. Develop your financial goals. Setting goals will help you a direction for your plan and destination towards which you want to head. So when creating financial goals, you will want to consider obvious objectives such as monthly savings or retirement investments. So when developing your goals, be sure to differentiate between necessities and wants. Establish priorities, right? So while determining your financial goals, you must set what your priorities are. Considering the net worth you calculated in step 1 and how realistically your goals again with your current financial situation. The goals which you have set, that to what extent, keeping in mind your financial wealth, these goals are achievable. Once you have set your goals, refer to your target date and duration of your goals. Means which goals you want to achieve after 3 years, goals you want to achieve in a current year, after 3 years, 5 years, 10 years. So depending on the short term, long term, medium term and long term goals, right? Identifying alternate course of action. So devise strategies to help you bridge the gap from where you are today and where you would like to go, right? Means I want after 10 years, I must have a house. So you have to devise a strategy that what are the different course of action which are available for me, right? So generally your alternative course of action will fall in one or two of the categories: reallocating existing resources and generating new ones. Means that whatever the resources are, you reallocate it and try to create new income, new sources of income, even by working extra hours, by making good investments and all those things. So generating new resources may require changing jobs. Means you are working in a company, if you find that you need extra money, so you look for another job where you can have a pay hike, reasonable pay hike. So changing jobs to improve your wage outlook, taking additional hours or investing your savings in more aggressively to generate higher rate of return. So evaluate your alternatives. I've already talked, keeping in mind the risk, keeping in mind the return and all those things, you evaluate those. Create and implement financial plan and review and revise your plans, right? It's a never static term, it is a dynamic term. You keep on revising your plans as per your requirement, as per your financial goals, right? So you keep on revising your plans. So our goals itself may change. As current goals wane from your list of priorities and you develop new goals, your plan will have to change to help to lead you to your new objectives, right? Sometimes, friends, we have at this point of time, because see, as the time changes, your priorities may also change. Your financial goal may also change. Supposing today I am earning 1 lakh rupees. Tomorrow, means after 1 year, after 2 years, I get a good opportunity to earn 2-3 lakh rupees per month, right? So I suddenly change my job and my income is trebled. I am being offered a job of 3 lakh rupees. So then my goal itself will change. Earlier, I used to think if I have a car of 10 lakh rupees, it will be a very luxurious car for me, and when my income was 1 lakh rupees. So I was planning to buy a car after 5 years of 10 lakh rupees. Once I get a job of 3 or 4 lakh rupees per month, I can even think of buying a car of 25 lakh rupees or 20 lakh rupees of that category, right? So your goals may change as the time changes, your financial position changes, right? So the fact of the life is that your life changes, your financial plan will have to change too. Be faithful in reevaluating your plan from time to time to ensure your goals have not changed and that you are on pace to reach those goals. So whatever the goals you have set or the changed goals you have set, you see to it that these goals are achieved, right? So apart from the steps in the financial planning, now let me come to the personal financial statement. Friends, this is all financial goals and financial planning. That, as I said in the first statement itself, first step in the financial planning, basically I was referring to, when I was talking of steps in the financial planning, I was basically referring to financial statement itself. I was saying that you assess your financial situation. You jot down your assets, you jot down your liabilities, and the base of this. This is basically, I would say, financial statement. And when you make the financial statement, apart from that, you also see that what are your monthly expenditures and what is your income. Means you prepare your receipt and expenditure payment account, or I would say your income and expenditure account. Not in the income and expenditure in the and receipt and payment account exactly in the financial accounting point of view, just to understand from the financial statement point of view that what are your sources of income, what are your regular income, means in terms of monthly income and the yearly income. Normally we prepare financial statement for a month or for a year. It may be any period of time depending on your own requirement. And also point out what are your expenses during that period of time. And on the basis of that, you can make a good financial statement so that you know exactly what exactly is your level of savings, right? Or if in a particular month there may be a negative saving, in the sense you can arrange, like the way we prepare the budget in business, we prepare the budget. Why do we prepare the budget? So that we know in advance that what are your source of cash inflows and what are your cash outflows. And if in a particular month or in a particular period your cash outflows are larger than the cash inflows, then you have to manage where from these cash outflows will be arranged. Means from where you will meet out your expenses. Similarly, in your personal life also, you prepare your financial statements. So in case of an individual, we prepare financial statement to know the income and expenses of a particular period and the resultant surplus or deficit. So we do not call it a profit and loss account, but we prepare that, is there any particular month or in particular year our expenses are more than our current income, right? So you prepare a financial statement of your assets and liabilities and on the date. In addition, we also prepare budget to estimate the income and expenses of 1 year, right? So this is basically the financial statement. So broadly speaking, there are 3 types of financial statement which we prepare. The income and expenditure statement, in which we jot down or write down all our sources of income, that monthly income, the yearly income, all our expenditures, right, of the period for which we are preparing. We prepare our balance sheet, balance sheet means like the business balance sheet is being prepared. Similarly, in the personal finance also, we prepare our balance sheet. We prepare all our assets, that what are your assets which you own in form of cash, in form of your bank account, in form of your mutual fund investments, the provident fund investments, the bond investments, fixed deposits, right? Investment in gold, real estate, and so on and so forth. Similarly, your liabilities, right? How much loan you have taken, where you have to pay, all these things, balance sheet. And then you prepare the budget, right? So more or less these are of similar type of statements. Budget means that for a period in advance, budget is always prepared in advance. It is a statement which is prepared prior to a period of time. है ना? So prepare for a prior of period of time. For the coming year you prepared. What are your expenses, what are your incomes, and so on and so forth. Right? So these type of three statements which are required, and budgeting of income and payments is very, very important part in the financial planning. Individuals who want to monitor their finances and ensure their spending responsibility must develop their own personal budget, right? Because see, if you prepare the budget, you can plan your expenditure also. You will make prudent expenses. You will incur prudent expenses. You will not incur extravaganzas, expenses on extravaganzas which is not in your priority, because you know what your level of income is. Sometime knowingly, unknowingly, we incur expenses which is beyond our limit from whatever source may be. And then certain expenses which are necessity in life, which has become the integral necessary part of your life, you find it difficult to meet out those expenses, right? So if you are making a prudent budget, you are preparing a prudent budget, you will be saving yourself from making unnecessary expenditure. So a personal budget or a household budget simply tracks a household's money in versus money out. Though a budget can be used to help an individual or family spend less and save more. How spend less? So that we know what our limits are, what our incomes are, and you know that you are a disciplined person, where you know that 30% of your income you have to save. Unless it is absolutely necessary to spend the money, you don't spend on it, right? So you will be spending the money prudently, so you will be able to save more. So it is most basic a planning and tracking tool. Budget means a forecast or estimates of future receipts and payment. Similar statement is prepared under personal financial planning, which helps the individual to manage his funds effectively, as he would be knowing the future income and expenses in advance. So friends, preparing the financial statement is a very important aspect in the financial planning or personal financial planning, rather I would say, which includes three statements, basically the income and expenditure statement, the balance sheet, and the budget. So for today and for this lecture, that's all from my side. Thank you very much. So in this lecture, I have talked about two things basically. I have talked about the steps in the financial planning, and then I talked in brief about the financial statements. Thank you.